Okay, so we were discussing about the options and we have now done dealing with buying and selling of options. Buy, call, buy, put, sell, put, all the four varieties we have seen. But what we have taken is strike prices which are very close to the current market price. The strike price near to the share price is called as at the money, and the strike prices which are away, far away, is called as out the money, and the strike prices which are within is called as in the money. So at the money, out the money, in the money. We have seen at the money, we have seen out the money. Let us now see in the money. Now, what is my view on Nifty? That Nifty would rise. So, what I can do, I can buy a call. But again, to buy a call, I have got various options. These are also calls. Now, you may wonder, the price of Nifty is above 18,000. How come people are buying a call of 15,000? That's what it is called as in the money, which is the shaded area, which is the price is within the strike price. For put, it will be opposite, because in put we are betting on the market fall. So any strike prices above the current market price will be called as in the money for put, and strike prices which are below the current market price will be called as in the money for call. Hope there is no confusion here. Now, what is the difference of buying a call which is in the money? Let us take an example of 18,000 Nifty. We buy at 400. I am taking a round figure as 400. Right now. So what may happen at these points? Quickly calculate and let me know. Break even point, very simple. Add the strike price. This is going to be 0. So 1 minute of time, calculate the values, then I'll tell you what's the difference. Alright, so let us complete it. So one thing we know that we would be in profit if the price is rising. So how much profit we would make here is 100, then 200, 600. How did we get these values? Nothing but expected expiry price minus the break-even point. Break-even point. So 18,600 minus 18,400, 19,000 minus 18,400. That's how we have derived at these values. And then 18,000 minus 18,400 is 400 points loss. 17,000 minus 18,400 is 1400 points loss. But how much we have to write here? Only 400, because loss is limited to the premium. It cannot trade in negative. It can only worst case become 0. Hope you have got the same values. In case you haven't, kindly rectify. Now, buy call, we have seen an example above. Here also we are making money in the rising market. Here also we are making in the rising market. Here. Now question is, we are losing a limited amount in case we are wrong. In case we are wrong, we are losing only 60 rupees here, while here we are losing 400 rupees. Then why would anyone buy this call? Question is, why would anyone buy this call? When the risk is higher, when the view is same. Observe carefully the break-even point. What is the break-even point here? 18,400. And in the call above, what is the break-even point? 18,560. So it's just like saying, I am betting with you, stating that England is going to win the match, but it may not be by a big margin. It may be only by 10, 20, 30 runs. It can be big margin, it can be small margin, but England is going to win by minimum 10 runs, by minimum 2 wickets. Chances are that there's a high chances that I would win the trade. Likewise here also. Though the view is bullish in both the cases, however, here you have to be too right. You have to be expecting a market sharp rise, not just rise. Then only you will make money. But in the second case, even if the market rises little bit, it's already at 18,350. So just 50 points away, you'll start making profit. At 18,500, there you would make loss, but here you would make money. So if you are able to take higher risk, the probability of profit increases. But if you want to take less risk, the probability of profit reduces. So that is the power of in the money options. Alright, let us take an example of even sell call. Just the opposite. Note it down fast. Plus becomes minus, minus becomes plus. Simple. Alright, so now coming to the put side. So here what would be the advantage to the seller of the option is that he would make really big profit compared to the previous case. But the risk taken is also higher because if he is slightly wrong, no problem. Though market has risen 50 points, he expected the market to fall, but market rather rose. Still, no problem, he is not punished. But if he is too wrong, he is going to be punished. If he is too wrong, he is going to be punished badly. How much wrong you are, that much big punishment. This is the game of options. So it's not just about being right or wrong, it's about how much right, how much wrong. That is the problem here. Simple cricket betting is like right or wrong, and the trade is done. But here you need to also be judgeful how much right you can be, how much wrong you could be. That is why options is complex. I remind, neither in the money nor at the money, or neither at the money. In the money, at the money, out the money. Buying of options or selling of options. Call or put. Stand alone, nothing is good. Till now, whatever that we have seen does not have any kind of edge for you to win the trade. All the options have got same formula: high risk, high reward, low risk, low reward. So that means the system does not have any edge. We do not have anything in our favor. It's only a probability game so far. But now we'll be dealing with two leg options. That is where the odds will come in your favor. Alright? Then last two examples we'll see for in the money put. So for in the money put, we'll have to take strike prices which are higher. 19,000 put is available for 600 rupees. Quickly compute the profit loss at these points. Hope you haven't forgot or not confused. What's the break-even formula for put? Add the strike price. Sorry. Strike price minus the premium. So this is going to be the break-even point. Take another value. 1 minute of time. Quickly compute. Right, so let's do it. So we are going to gain money whenever the price is falling because we are buyer of a put. How much we would gain here? Break even point minus the expected price of expiry. But in case we are wrong, we would lose how much? Maximum of premium. Here how much we would lose? 18,400 minus 18,600. We would only lose 200. In case you have made this as 600, please rectify. Maximum is 600. Alright, kindly tally the values. And then finally the selling of options. So plus becomes minus, minus becomes plus. Alright. So this is what all options would be on standalone basis. Now coming to the interesting part, that is dealing with multi-leg options. I've repeatedly been saying that none of the strategies that we have seen so far has got any edge. That means nothing is in our favor. It's just like a cricket game. If the probability is high of any team winning, the reward will be less, isn't it? The probability is low, what will happen? The reward will also be very high. Now I am coming to an example. Let's say that India and Pakistan, both the teams have got 50-50 chance to win the match. I say that if you are right, for your 1 rupee I'll pay you 2 rupees, not 1 rupee. That means 2 is to 1. On 1 rupee risk, you are getting 2 rupees credit. If you are wrong, only 1 rupee will be gone. But if you are right, not 1 rupee, you would be getting 2 rupees. That is what is called as edge. Head and tails. I toss a coin. I say that if you lose, pay me 100 rupees. But if you win, I will pay you 200, not 100. Like that continuously, if you bet it out of 100 games, 50 you may lose. So you will be losing 50 into 100, that is 5,000. and 50 you win. But how much you'll be winning? 10,000. 200 into 50. Overall, you will be in a profit. That is what is called as edge. And that edge comes by hedging. Now, right on. Interesting topic. And before I forget, so whoever's fees is pending, it is time for the second installment. Kindly clear the dues before tomorrow's class. Bull call spread. What do we do here? Buy, buy high premium call expiry and sell low premium call expiry. This is a combination that we will be doing. Let us take an example of Nifty itself. Nifty 18,400 CE, buy at 105. I'll take round figure as 100 and 18,600 as 30. This is a strategy that we need to adopt in case we feel that the market may rise slightly. So what would happen at these points? Compute and tell me. 17,000, 18,000 by 70. So 18,500. Then this is 70, 18,470. Hold on. What is so special about 470? You'll get to know shortly. Okay. Now here you will be computing both of them. What is that? $18,400 call expiry. What is the profit loss you need to compute? 18,600 call expiry. What is the profit loss you need to compute for both of them? Okay. And then this will be seeing the total. Alright. So for this you may require more time. 5 minutes of time. Compute. Let's see who can get it right. So firstly do only this leg, then do only this leg, then add it and show it in the total. Always understand the thumb rule. First calculate the break-even point, then mark the notions plus or minus and then compute the values. That's the easiest approach towards options. Okay, so let us calculate now. 18,400 call expiry is bought at 100 rupees, means because it is a call expiry, I add this premium to the strike price, I get the break even point. So here I know that I do not make anything, zero. And one thing I know, that I am a buyer of a call, so I would be making profit when the price is rising. And the formula we know is very clear, the price minus the break even point. So I would make here 100 rupees profit, here I would make 130, here I would make 300 profit, here I would make 500 profit. Hope you have got the same values. Here I would rather make a loss. How much loss? 470 minus 500, I would lose 30 rupees of premium. Here I am going to lose my entire premium, 100 rupees, and so is at this price. Kindly check and tally. Now coming to 18,600 call expiry, this one I have sold it, but doesn't matter, it's a call expiry. So for break even point, I would add these two values. So this is the break even point for the second leg. Alright, and then I would be making loss if the price is rising, because I am a seller of the call. So how much loss I would make? This one minus this one. That is, I would lose 170 points here. Here how much I would lose? 370 points. Hope there is no confusion. Sorry, this is only 70 points, right? 700, sorry, 170. My mistake. Alright, and here we would gain. How much? Maximum you gain is only the premium. Because something you sold at 30, maybe you will have to buy that at 0. You cannot buy negative. The profit is going to be limited only. So how much is the profit loss here? I would lose 70 points. That's the worst case loss. Even if market goes down to 0, I would only lose 70 points. This is 0. So this becomes the break even point for the combined strategy. All this will be 130 only. So imagine you are two equal powerful teams are playing the cricket match. If you are wrong, you lose 70 rupees, but if you are right, you can win 130. This is where the odds come in our favor. This is what we need to do. This is a perfect kind of option hedging strategy wherein over a long run, maybe first trade you will lose, maybe second trade you will lose, then again there will be back-to-back trades you will win. Overall in total you have to see. See, in our cricket team, out of 11 players, everyone doesn't hit century, right? Someday it will be Virat Kohli, someday it will be Rohit Sharma, someday it will be KL Rahul, someday it will be Rishabh Pant, someday it will be Pandya. Overall, there has to be a score for the team. That's what we need to see. Here also, today you may lose a trade, tomorrow you may win, day after tomorrow again you may lose, then you may win back to back for 3. Overall, after 100 trades, what you have made is what is important for us. That should be a good profitable figure. This is all what we can do it in the market, which is in our control. Where the market will move, we have absolutely no control at all. Tomorrow, where will Nifty be? Today evening, where will Nifty close? Neither you can say nor I can say. Why? because there are multi-crore traders who are buying and selling every day. Some feel that some are buying, some are selling. How can you judge what will happen? Just like saying elections. To an extent, we can forecast the outcome of the election. But can you forecast by how many votes a party will win? We cannot. We can roughly say that this party may win or that party may win. That too we cannot be assured. But by how many votes they will win, that super talent we do not have. That's why better to deal with the multi-leg strategy. Here the break-even point is also very practical. We have time till 17th November. Market has to just rise by 100 points and we are on a safe zone. Then how much your market may rise? Our reward is going to be limited. But to say, you may say, sir, this, even though we are right too much, yet we are making limited profit only. Yes, this is the drawback. For a buyer of an option, he would have made a jackpot income, isn't it? He felt that the market would rise. Rather than doing this, he only does this one. He would make jackpot profit. But what I am saying, such kind of sharp rise is a very rare event. He will lose 10 trades, then he will win the 11th trade. What is the use? He might have lost several times this one to gain one big trade. Overall in total, he may not be in profit. Individual trade, one trade he may be in profit. Out of 20 trades he takes, once a jackpot will be, he'll be able to capitalize. That's a very rare case. But this is achievable. This is easily achievable. At 18,600, the buyer of a call makes limited profit, but the call spread, what we have done, he makes little excess profit, and the probability of this happening is higher. This can easily happen, guys. But this to happen in a short time period, difficult. That's why buying of options is not good. Combination of options is good. So here what will happen is the probability will also increase. The range of profit will also increase. But only drawback is you will not be able to make any kind of jackpot income when it comes to hedging trades on individual trade. Write down, very important note. And you know what? If you are further talented, you may reduce this loss to even 60, even 50, even 40. Imagine. First of all, if we are right, we are making fantastic income. But even if we are wrong, see, we have time till 17th November, right? That means Monday, Tuesday, Wednesday, Thursday, 4 days are there with me. After the day today, that means by end of today, if I see that the market is not moving higher, I am actually going into the loss zone, I will do some adjustment. What adjustment I may do? I may change my strike price from 18,600 to 18,500. Like that, there are a lot of adjustments that we will be doing. That's an advanced options which we'll be discussing later. But I'm telling you that there is a provision for that as well. I don't have to compulsory carry this trade till 17th November. I can exit the strategy even between. Even on Monday I can make it zero. But I'm not going to make it zero. What I'm going to do? I am going to adjust my trade if I am going wrong. If I'm going right, I'll keep quiet. If I'm going wrong, I'll try to minimize this loss further. Right now the risk reward is almost 1 is to 2. We can further reduce the risk. 70 points can be brought down to 60, 50, even 40. So that art we'll be seeing later. Firstly, we'll be dealing with multi-leg options. So like that we have done for call spread, exactly opposite is for put spread. Sorry, here bear call spread also we'll see. Let us first see the put spread. Strategy 2. $18,200 PE, buy at 44, and 18,000 PE sell at, I'm taking round figure as 20, 45 and 20. Now we are going to compute the profit and loss at these points. Let's see who can get it. Here one more figure we need to add. 25 minus 20. So 5 minutes of time, compute the values for this one plus this one and then in total. Okay, so I hope you have finished doing it. Let us quickly do it. Firstly, the break-even point 18,200 minus 45 is 18,155. This is the break-even point. That's a thumb rule. Always calculate first break-even point. Then one thing I know that I would be making profit when the price is falling because I am buyer of an option. So how much? Whatever the price minus the break-even point. Sorry, the break-even point minus the price. So here I'll be gaining 155. $175. Here I'll be gaining. So this is 155, 175. This is 17,000. So double 155. Hope you have got the same values. Here I would make loss. 20 points I would lose. Maximum loss would always be premium if I am wrong, because I am buyer of an option. And I would make loss when the price is rising. But a seller of an option would make profit when the price is rising, but maximum profit would be premium. So 18,000 PE is bought at 20. So what's the break even point? 980. So this is going to be 0. And then here I am going to lose big. How much? Minus 980. Isn't it? Here I would be losing the premium. Sorry, I would be gaining the premium. So plus 20 everywhere. Sorry, this is minus 45, right? This is 20 only. This is going to be 45. Why? Because premium what we have paid is 45. So if you see in this strategy, our worst case loss is only 25 points, but our reward is going to be pretty huge, 175 points. So if you are wrong, you lose only 20, but if you are right, you would gain 175, which is and risk reward of 1:8. Amazing. And this is little achievable. Why? Because we are not waiting till here. Only if this also happens, we are going to make 175. We are at 18,300 and a 300 point fall is a matter of one day, guys. Even a slight bad news. Russia strikes back or Ukraine joins NATO, and you'll see that market falls down by 300, 400 points in a single day. So though we are saying that risk reward is in favor, the probability is also high. That is important. Probability is more important than anything else. So the break-even point together is 18,175, which is not far away, just 120, just 200 points away. Nifty falls by 200 points away, you'll start making profit. And let it fall little bit, you'll make a jackpot profit. And even if you're wrong, you would lose only 25. And most importantly, this 25 loss can also further be reduced to 20 points, 15 points, and even 10 points. When we see that this is not happening by Monday, Tuesday, Wednesday, we will adjust. What to adjust? That later only I can tell you. We'll adjust this to reduce our loss further. So that means you will be having very few loss making trades, and the loss are going to be very minor when it comes to hedging. Alright, so now the opposite. Strategy 3, bear call spread, where buy becomes sell, sell becomes buy. Here also the loss and profit both will be limited. Always understand, when it comes to hedging, both profit and loss becomes limited. But the risk reward to this strategy is not favorable. I don't do this, but because it is a strategy, you should know. Never do any hedging strategy where the risk is higher than the reward. Always understand, never do any strategy where the risk is higher than the reward. Plus becomes minus, minus becomes plus. Quickly do the changes. Then why would anyone do this? 80% he will make that profit, guys. If you see, though we say that the risk reward is not in favor, but the chances of making profit is 80%. In call spread and all, it is 50%. Call spread, put spread, but here it is 80%. But then we can't take such a risk for 80% probability of profit. But then here again we can make this plus 80 to plus 70 to plus 80 plus 90 plus 100. This one we can reduce it to 110, 120, 100 by adjusting when we see that prices are not moving in our favor. This note is not important again. Firstly, note down this one. Alright, and then finally, strategy 4, bull put spread, wherein buy becomes sell, sell becomes high, buy. Plus becomes minus, minus becomes plus. When to apply which strategy, that is what is the main game, which we'll understand later. But first understand what all types of strategies we have got. Then you'll get to learn which strategy to adopt when. Those rules I'll be telling you by working with technicals. We'll also see then how to adjust in case we are wrong. With a practical example I'll be showing you. Okay, so that's it, guys, for today. We have discussed 4 different strategies: bull call spread, bear call spread, bear put spread, bull put spread. So, by end of the session, my statement would be same till I'm dealing with the options. Practice. I did all this for Nifty. You do it for your favorite stocks. At least 5 different companies you do all these 4 strategies today. Then only you'll get the grip over the market. You want to make good consistent income on a safe way in a professional way, then practice is must. This is all maths, maths and maths. But simple calculation, not like your calculus and all that. So any doubts or questions, I open the floor to clarify all your queries. You can use the chat window, the audio control.